Maureen Lein, your local lender from Rate, here on Wednesday, August 13th. I'm going to be covering data from Tuesday the 12th, as well as today, Wednesday the 13th. We've had some major data releases this week, and there's a lot happening behind the scenes that it could impact mortgage rates in the weeks ahead. So I'm here to break it down for you in a way that actually makes sense, even if you're not a mortgage or market expert. So inflation, CPI, why does it still matter? Well, on Tuesday, we got the July CPI report, and that's the Consumer Price Index, one of the key inflation readings the Fed watches when deciding on rate changes. And here's the deal. The report wasn't bad, but it wasn't great. Core inflation, which strips out food and energy, rose from 2.9% to 3.1% year over year. And a big reason inflation is still high, well, shelter costs, and more specifically, a stat called owner's equivalent rent. That's an estimated rent value that homeowners think they can charge, but it's not always realistic or current. Unfortunately, it does make up a third of the inflation calculation. So even if real costs are dropping elsewhere, that laggy data keeps inflation sticky. Other factors like airfare and some tariffs added small bumps, but when you factor in their actual weight in the index, they didn't move the needle much. So the bottom line, everyone, inflation isn't rising out of control, but it's not cooling fast enough for the Fed to confidently cut rates yet. Let's talk about the mortgage bonds and treasury spread. Well, there is a glimmer of hope here, and this is where it gets a little bit more technical, but stick with me because this part does matter in regards to the rates. So we've seen mortgage bonds improve, even while the 10-year treasury yield ticked higher, and normally mortgage rates follow the 10-year. We're actually seeing a disconnect right now, and that's good news. That disconnect is actually narrowing the spread between the mortgage rates and the treasuries. And that spread had been way above normal. In fact, over 3% at one point, and now it's tightening closer to 2.35%. Historically, that spread sits around 1.6 to 2%, so we still have room to improve. But this narrowing does help take pressure off the mortgage rates, even if the broader market is volatile. And let's discuss the home values and the ICE Mortgage Monitor. So we did also get the ICE's Mortgage Monitor report this week, and it showed a slight drop in home values, but that was seasonally adjusted. So in real terms, prices likely rose a bit, just not as much as expected. And the takeaway, well, home prices are stabilizing, they're not crashing. And most importantly, refinance potential is huge if rates come down. Right now, about 1.6 million homeowners are in the money to refinance. And if rates drop to just over 6%, that number could jump to 4.8 million, unlocking a wave of activity. And let's discuss the applications. So there was a purchase lag and a refinance increase. And this all thanks to the weakening of the job report. So refinance applications rose 23%. Purchase applications only rose 1%. But here's the thing. It's all about timing, and it's expected. Refinancing is quick. Rates go down, people act fast. But buying a home, it takes time. So if rates stay low, purchase activity should follow. There's just a little bit of lag. So don't give into that media spin that rates aren't helping. And what's next? Well, the Fed, PPI, and market movements. So the next Fed meeting is going to be September 17th. And while the odds of a big rate cut, like 50 basis points, are low right now compared to last week, they're around 3%, it could change depending on the upcoming data. So we can see a bigger move maybe in September if they feel it should have been done sooner. And it's a long shot, but not impossible. So let's cross our finger. Also, there's buzz around who might be replacing Jerome Powell as Fed chair. And the White House just released a list of 11 candidates. That's still early speculation, but leadership changes can influence Fed direction in the long run. So what is your takeaway from my video today? Well, let's talk about it. So inflation, it is still stubborn, but it is improving slightly. Mortgage bonds are improving and spreads are narrowing. That helps keeps rates from rising. Refi activity is heating up. And if rates drop further, we'll likely see more buyers enter into the market too. So if you're thinking of refinancing, buying, or just have questions in regards to financing, give me a call. I want to connect with you and I want to make sure that you're positioned to take advantage of all of this.